I want to point out to people, last month was a record. They used $108 billion of that. They were at $4 trillion in January of 2014. We all know when we feel like we've got enough money saved for a rainy day, sometimes a couple of rainy days in a row, and even maybe $4 trillion is not enough. Shah, is there a chance that we decouple somewhere along the line and that we take our cue from domestic events, particularly the jobs report tomorrow, rather than the shenanigans in China?
No, there's no chance, very unfortunately, Charles, that we're going to decouple. As a matter of fact, what we're seeing in China was a trigger, and that was rightfully so. What investors should be worried about that. But underlying the headline numbers, in other words, the headline index numbers that we call the stock market, the NASDAQ Composite, the Dow Jones Industrial Average, and the S&P, which are down 10% from their highs, the rest of the market underneath, the real stock market, not the leaders and momentum darlings, the average stock is down 24.1%.
Right.
Off of its 52-week highs. So we have tremendous weakness underneath. The best performing sector in the market, which is the consumer staples, the average stock in the consumer staples group is down 16%. The market's down 10%. The best performing sector is down 16%. There's a huge divide in there that's going to be filled. It's going to be filled by the indexes coming back down to meet where the average stocks are, and it's going to be ugly.
All right. I wanted to go into a more detailed nuance about how the rest of the market may look, but I want to stay on this global macro picture for just a little bit longer, Jim, because this is driving the market. We haven't even talked about North Korea, igniting a nuke, ISIS, and all the other things, because I feel part of the problem is leadership. Or lack of leadership. We don't think the Chinese leaders can get their act together. We know American leaders can't get their act together. The world feels like a rudderless ship, and that's got to be playing some sort of intangible role here.
Well, I think it's a general malaise in the background that on the margin is a negative. But the markets are very capitalist-driven. They are money-driven. They are not driven by their thoughts about leaders. So your point is a good point, but it's not the most important point. The most important point for the United States stock market right now is to watch the junk bond market. If the junk bond market deteriorates from here, it means that fears of a credit event are overwhelming the reasonable economic news that we're experiencing in this country.
And Danielle, that junk bond market driven in part by all the money borrowed by some of those frackers in your neck of the woods.
Absolutely. And we're already starting to see some of the fallout with respect to that. A lot of the private equity money that funded the shale revolution came out of this neck of the woods. So I absolutely agree with what Jim just said. We need to. The one area I think where global market and geopolitical tension could spill over into U.S. markets would be the contagion effect into where we'll see it absolutely first, and that would be the junk bond market. So I have to agree that we need to keep a close eye on that because there's been so much money thrown into these markets. They're multiples of what they were in 2007 at their prior peaks, and I don't think policymakers have a good feel for how they're going to react in the event that there's some kind of a systemic contagion.
I got to tell you, well, we're going to come back, guys. But I will say, every smart investor I know, brilliant ones, all either short or avoiding junk bonds. You're absolutely right.